You applied for an apartment last week. Good credit, stable job, references ready. The landlord called yesterday and went with someone else. No explanation, just a polite rejection. You're starting to wonder if your credit score is quietly destroying opportunities you don't even know you're losing. Here's what's actually happening. Your credit score isn't just a number that determines whether you get a loan. It's a silent filter running in the background of your entire life, making decisions about you before you ever walk into the room. And most people have no idea how many doors it's closing. Let's start with employment. 47% of employers now run credit checks on job candidates. Not for every position, mostly for roles involving finance, management, or access to sensitive information. But here's the problem. They're not looking for a perfect score, they're looking for red flags. A history of late payments signals unreliability. High credit utilization suggests financial stress that might make you desperate. Collections or charge-offs imply poor judgment. You might be the most qualified candidate in the interview, but if your credit report shows chaos, someone else gets the offer. You'll never know that's why. Insurance companies are even more aggressive. 95% of auto insurers use credit-based insurance scores to set your premiums. They've determined through decades of data that people with lower credit scores file more claims. Whether that's correlation or causation doesn't matter to them. If your score sits below 650, you're paying anywhere from 20 to 50% more for the exact same coverage as someone with a 750. That's an extra $400 to $1,000 annually, not because you're a bad driver, but because your credit history suggests you might be. Then there's housing. Landlords don't just check if you can afford the rent. They're assessing risk. Two applicants, same income, same references. One has a credit score of 720, the other 620. The 720 gets the apartment. The 620 gets a polite email. In competitive rental markets, landlords use credit scores as the tiebreaker. And if you do get approved with a lower score, you're putting down a bigger security deposit or paying a higher monthly rate. The cost of bad credit isn't just interest. It's every single transaction where your financial history gets reviewed. Utility companies check credit too. When you move and set up electricity, gas, or internet, they pull your score. Low score means you're paying a deposit, sometimes $200 or more per service. That's money sitting with the utility company, earning them interest while you wait months to get it back. High credit score, no deposit. You're trusted by default. Even your phone bill is affected. All major carriers check credit to determine whether you qualify for device financing or if you're paying full price upfront. Miss a few payments elsewhere in your life, and suddenly that new phone costs $1,000 today instead of $42 a month. But here's where it gets truly expensive. Mortgage rates are tiered directly to credit score ranges. The difference between a 3.5% interest rate and a 4.5% rate on a $300,000 mortgage is $60,000 over 30 years. That's not a typo. $60,000 paid entirely because your credit score fell into a different bracket. You're buying the same house, living on the same street, but paying the price of a luxury car and extra interest. Most people think credit scores only matter when you're borrowing money. That's the story we've been told. Get a loan, pay it back, your score goes up. Simple. What nobody explains is how credit scores have metastasized into a universal risk assessment tool that follows you everywhere. They've become a proxy for character, responsibility, and trustworthiness that determines how much you pay for nearly everything. And the system is designed to keep you trapped once you fall behind. Here's the mechanism. Low credit score means higher interest rates. Higher rates mean larger monthly payments. Larger payments strain your budget. Strained budget leads to missed payments. Missed payments lower your score further. The spiral tightens with each rotation. You're not climbing out. You're sinking slower. Credit card companies understand this perfectly. They offer cards to people with damaged credit, but at interest rates that make recovery nearly impossible. 28% APR on a $3,000 balance means you're paying $70 monthly in interest alone before touching the principal. Make minimum payments, and that debt follows you for decades. The math isn't designed for you to win. It's designed to extract maximum revenue from financial vulnerability. Meanwhile, someone with excellent credit gets offers for 0% introductory rates, balance transfers with no fees, rewards programs that pay them to spend. Same economy, Entirely different game. The gap between those two experiences is worth hundreds of thousands over a lifetime, and it compounds because bad credit keeps you poor, while good credit accelerates wealth building. Most financial advice tells you to pay off debt and your score will improve. Technically accurate, but it ignores the reality that you're simultaneously being charged more for everything while trying to recover. You're running uphill in a rainstorm while someone else is coasting downhill on dry pavement. Then they wonder why you're not keeping pace. The credit system measures your past to predict your future, but it creates the very future it predicts. Label someone high risk, charge them accordingly, make financial stability harder to achieve, then point to their continued struggles as proof the system works. It's circular logic backed by statistical models that nobody outside the industry can examine. You want the real strategy? Understand that your credit score is a product you're building whether you realize it or not. Every payment, every balance, every account is either constructing or demolishing your financial reputation. Most people treat it passively, dealing with consequences only when they're denied something. That's backwards. You manage it actively, checking it quarterly, disputing errors immediately, optimizing utilization, diversifying account types. Not because you're obsessed with the number, but because you understand what that number unlocks. A 760 credit score isn't about responsibility or virtue, it's about access. Access to lower rates, better terms, more opportunities, and fewer obstacles. It's the difference between paying extra for permission and being welcomed in by default. Nobody teaches this in school because the system profits from your ignorance. The longer you operate without understanding how credit actually functions, the more money flows from your pocket into theirs. So here's what you do. You stop thinking of credit as something that happens to you and start treating it as something you control. You make it boring, predictable, and automated. You pay everything on time, keep balances low, never close old accounts, and let time do the heavy lifting. That's it. No tricks, no hacks, just consistent behavior that the algorithm rewards. Because on the other side of that 760 is a completely different financial reality where the world costs less, opportunities appear more frequently, and your money works for you instead of against you. That's not motivation, that's math. You've been playing a game where the rules were never explained and the scoreboard determines what you pay for everything. Your credit score isn't measuring your worth, it's measuring your access. Fix it not because you're broken, but because the difference between a 620 and a 760 is the difference between expensive permission and automatic entry. That gap costs 6 figures over a lifetime. Close it.